Jeffrey Epstein, the financier, was a college dropout who managed to amass a fortune that remains difficult to explain. He owned two private islands, multiple private jets, and homes all over the world. He befriended presidents, princes, scientists, celebrities, businessmen, and billionaires, and was described by financial analysts as a man of nearly infinite means. Yet despite years of investigations, no one can say with certainty how he made his money. Bloomberg wrote that for all his prominence, there are scant details of how he made his money. The Financial Times similarly wrote that this question has confounded journalists for decades. Given his links to big names, there has been major public interest in understanding the wealth of Jeffrey Epstein and how someone with his background achieved such financial success. Epstein was born in Brooklyn, the son of a groundskeeper and a stay-at-home mom. He graduated high school and briefly attended Cooper Union and NYU before dropping out of both. After claiming to have credentials, he briefly taught math and physics at a private high school in New York before leaving after 2 years. He went on to work for a few years at Bear Stearns, and after departing claimed to be running a money management firm for the ultra-wealthy. His firm's operations were opaque, its client list never disclosed, and its assets never verified. He had only one confirmed client, and everything else remained speculation, secretive offshore entities, and a social circle that included everyone from U.S. presidents to British royalty, created an air of mystery around his actual business operations. The questions around Epstein's financial dealings became a topic of renewed interest in recent years. Financial journalists and investigators have tried to piece together how someone from his background built such massive wealth. Bloomberg and other financial publications have written extensively about the gaps in understanding his business model. The challenge has been that standard financial transparency didn't seem to apply to Epstein's operations. His wealth management firm operated with unusual secrecy, even by the standards of private wealth management. This opacity around his business operations has made it one of the most intriguing financial mysteries of the modern era. Despite the lack of clarity around the origins of his wealth, the scale of Jeffrey Epstein's fortune was undeniable. Financial filings estimated his net worth at roughly $560 million, while some sources suggested it could be as high as $600 million. His assets included an impressive portfolio of properties, including a $77 million Manhattan townhouse, a $12 million estate in Palm Beach, a $17 million ranch in New Mexico, and an $8.6 million apartment in Paris. His two private islands, Little St. James and Great St. James, were valued at $86 million. He owned 3 private jets, a helicopter, and a fleet of at least 15 vehicles. His most famous aircraft was a Boeing 727, which, if configured as a commercial jet, would hold 150 passengers. These holdings paint the picture of someone with immense financial resources, but the question of how he acquired them remains largely unanswered. Although Epstein was often described as a billionaire by media outlets, even financial analysts hesitated to confirm that label. His firm, Financial Trust Company, was based in the U.S. Virgin Islands and never released audited statements or performance data. This lack of transparency, combined with conflicting reports about the size of his staff and his firm's performance during the 2008 financial crisis, casts doubt on whether his fortune ever reached the scale he claimed. One of the most puzzling aspects is how someone operating with such secrecy managed to maintain credibility in elite financial circles for so long. Traditional wealth managers typically provide detailed performance reports and undergo regular audits. Epstein's operations seem to bypass these standard practices entirely. Epstein's early career offers the first glimpse into the unconventional path that would define his financial life. Born in the Coney Island neighborhood of Brooklyn in 1953 to working-class parents, Epstein dropped out of university without earning a degree. Despite this, he landed a teaching position at the elite Dalton School in Manhattan in the early 1970s. There he made connections with influential parents, including Alan Greenberg, the chairman of Bear Stearns, who helped him secure an entry-level position at the investment bank after he left teaching in 1976. Epstein rose rapidly at Bear Stearns, becoming a partner within 4 years, an unusually fast ascent, especially for someone with no formal financial training. But just 1 year after making partner, his career at Bear Stearns came to an abrupt end. According to the New York Times, Epstein told regulators during an investigation that he had been let go due to issues including lending money to a friend for stock purchases and expense account irregularities. Though never charged with any wrongdoing, the episode marked the beginning of a pattern. Epstein's ability to gain access to elite institutions and powerful people, often without the credentials or transparency typically required. After leaving Bear Stearns, Epstein launched his own firm, Intercontinental Assets Group, which claimed to specialize in recovering assets. By the late 1980s, he had formed J. Epstein and Company, the investment firm that would become his primary vehicle for wealth accumulation. Epstein announced at the time that he only accepted accounts worth over $1 billion. It's worth noting that there were fewer than 500 billionaires worldwide at the time, making his supposed client base extraordinarily exclusive. In reality, financial records suggest that Epstein had only one major confirmed client, Les Wexner, the billionaire founder of L Brands. For more than a decade, Epstein served as Wexner's personal money manager and financial advisor, reportedly earning substantial fees in the process. Their relationship was unusually close, so much so that Wexner transferred ownership of a $77 million Manhattan mansion to Epstein's Virgin Islands-based company for no recorded payment. According to the New York Times, a 2002 corporate filing revealed that Epstein's asset management firm had just $88 million in assets and around 20 employees, far fewer than the 150 claimed in media profiles at the time. In 1987, Jeffrey Epstein was hired as a consultant by Stephen Hoffenberg, then CEO of Towers Financial Corporation, a Manhattan-based debt collection agency. Hoffenberg paid Epstein $25,000 a month and set him up with an office. Together, the two men attempted high-profile corporate acquisitions, including bids for Pan Am and Emory Air Freight. However, Towers Financial would later be exposed as operating a large-scale Ponzi scheme. The company had been raising hundreds of millions of dollars by selling fraudulent bonds and promissory notes to investors. This money was used to pay off earlier investors and fund expensive lifestyles, including private jets and luxury homes. Hoffenberg later claimed Epstein was involved in the financial structuring of the operation. Court records show that Epstein's name appeared on organizational charts and that he held a position at the firm. Yet, despite his connection to the company, Epstein was never charged with any wrongdoing related to the scheme. This episode is one of the most puzzling examples of how Epstein operated in elite financial circles. His business partner was convicted and spent nearly 2 decades behind bars, while Epstein continued building his wealth management practice. The question of how he avoided legal consequences while being so closely connected to such a large financial fraud remains one of many unanswered questions about his business dealings. While Les Wexner is the only confirmed long-term client, evidence suggests Epstein had financial relationships with several other wealthy individuals. Though the nature of these arrangements remains unclear, the New York Times reports that Epstein briefly served as co-trustee for Johnson & Johnson heiress Elizabeth Johnson, managing land holdings in New York before stepping down in 1998. Epstein also had business ties with Leon Black, the billionaire co-founder of Apollo Global Management. Black reportedly paid Epstein $158 million over several years for financial and tax advisory services. This is particularly interesting given that someone of Black's wealth and resources would typically have access to top-tier accounting and legal firms. The fact that he paid such enormous fees to Epstein for what he described as tax advice has raised questions among financial analysts about the true nature of their business relationship. The Financial Times reported that Leon Black has attributed a significant portion of his family wealth to Epstein's financial guidance, saying that as much as $2 billion of his fortune could be traced to strategies developed with Epstein's input. Epstein allegedly advised Mr. Black on various matters, including asset management, and helped with financial planning. The relationship continued for years, even after questions emerged about Epstein's business practices. According to reports, Black later commissioned an independent review which found no impropriety in the business arrangement. However, the size of the fees and the duration of their relationship has continued to puzzle financial investigators trying to understand Epstein's business model. In 2023, Leon Black reached a financial settlement with authorities to resolve any questions related to his business dealings with Epstein. The settlement was reportedly in the tens of millions of dollars, though the exact terms remain confidential. According to reporting by Vanity Fair, Epstein's relationship with hedge fund manager Glenn Dubin illustrates how his social connections intersected with business. The two men were introduced through Dubin's wife, and despite the unconventional nature of their introduction, Epstein became closely connected to the Dubin family. This friendship translated into financial arrangements. Epstein allegedly received fees for helping facilitate business transactions and made substantial investments in funds managed by individuals connected to Dubin. These transactions demonstrate how Epstein leveraged personal relationships to gain access and legitimacy in financial circles. The pattern was consistent across many of his business relationships. He would enter elite social circles, develop close personal connections, and then those relationships would evolve into lucrative financial arrangements. When questions about Epstein's business practices emerged, many of these individuals distanced themselves from the relationship, claiming they were unaware of any issues. Epstein's name also appears in connection with Environmental Solutions Worldwide, a small company focused on emissions control in which he invested alongside individuals connected to Leon Black. This was one of the few companies for which Epstein's firm filed regulatory disclosures. The filing revealed that he had invested several $million in the venture. However, like many of Epstein's investments, the ultimate outcome and current status of this holding remains unclear. These various business relationships, many involving large sums of money but limited documentation, highlight the mystery surrounding Epstein's financial operations. He moved in elite circles, advised billionaires, and managed substantial assets, all while maintaining extraordinary secrecy about his business model and leaving almost no public record of his investment strategies or performance. In the late 2000s, Les Wexner disclosed that there had been financial discrepancies in his accounts managed by Epstein. Wexner stated that he had recovered some funds and had ended the business relationship years earlier. The exact amount that Wexner claimed was misappropriated has been reported as over $46 million. Wexner had granted Epstein extensive financial authority, including power of attorney over his accounts. This level of control is highly unusual in wealth management relationships and raised questions about the nature of their arrangement. Financial industry experts have noted that granting power of attorney to a money manager creates significant potential for conflicts of interest and abuse. Questions have been raised about whether Epstein's wealth came solely from legitimate investment management or whether other business practices contributed to his fortune. The lack of transparency around his operations has made it difficult to determine the true sources of his wealth. Financial investigators have noted that the secrecy surrounding his business model is unusual and even by the standards of private wealth management. Typically, high net worth individuals working with money managers receive detailed quarterly statements, performance reports, and regular audits. There's no evidence that Epstein provided such documentation to his clients or that his firm underwent the kind of independent verification that is standard in the wealth management industry. This raises questions about how he maintained the confidence of sophisticated investors and why they didn't demand greater transparency. One theory is that Epstein's social connections and the exclusivity of his operation created an aura of prestige that substituted for traditional credibility markers. Another possibility is that the returns he generated for clients were substantial enough that they didn't ask questions about his methods or structure. The investment strategy that Epstein claimed to employ has also been a subject of speculation. He reportedly told potential clients that he used sophisticated arbitrage techniques and had access to unique investment opportunities not available to ordinary investors. However, there's little concrete evidence of what these strategies actually were or whether they were real. Some financial analysts have suggested that the opacity of his operation and the lack of verifiable performance data raises questions about whether he was actually generating returns through legitimate investment activity or through other means. The fact that he had so few confirmed clients, despite claiming to manage billions of dollars in assets, has led some investigators to question whether his wealth management business was ever as substantial as he claimed. Let's examine Epstein's actual investment performance based on the public record that does exist. On the negative side, Epstein owned substantial Bear Stearns stock for decades after working there and remained heavily invested when the firm collapsed. In 2008, according to financial records, he held around 176,000 shares worth nearly $18 million in August 2007. He sold some shares at over $100, but as the firm failed during the financial crisis, he sold the remainder at just over $3 per share. The total loss on this position alone was estimated at over $15 million. He also lost approximately $50 million in Bear Stearns hedge funds that collapsed in 2007, marking the beginning of the financial crisis. These losses, totaling around $65 million, represent a significant portion of his reported net worth and raise questions about his investment acumen. There's also an interesting real estate transaction from 2011 that has puzzled analysts. Epstein sold a Manhattan property to Cantor Fitzgerald CEO Howard Lutnick at a 65% discount to what he had paid just 2 years earlier. This is notable because New York real estate prices actually increased during that period. The property was adjacent to Epstein's main Manhattan residence, and the discounted sale price has led to speculation about the nature of the transaction. While there may have been legitimate reasons for the discount, such as the need for quick liquidity or specific terms favorable to Epstein, in other ways the transaction stands out as unusual. Lutnick has stated that he had no personal relationship with Epstein and that the purchase was purely a real estate transaction. On the positive side of the ledger, Epstein made what turned out to be a very successful investment in Valor Ventures, a venture capital fund co-founded by Peter Thiel that focuses on financial technology companies. The fund has returned strong annual returns over the past decade, averaging around 15% annually. Epstein's stake, which he acquired around 2015 or 2016, has grown substantially and is now valued at approximately $170 million. This makes it one of the largest remaining assets associated with his estate. Interestingly, this investment was not publicly disclosed until recently, and only came to light during the administration of his estate. The timing of the investment is also notable, as it came relatively late in Epstein's career and represents one of the few documented successful investments in his portfolio. The Valar investment raises interesting questions about Epstein's investment strategy and connections. Peter Thiel is one of the most prominent figures in Silicon Valley and the venture capital world. How Epstein gained access to this investment opportunity and what due diligence Valor conducted before accepting his money remains unclear. Venture capital funds typically conduct extensive background checks on their investors, particularly for large commitments. Representatives for Valor have not commented publicly on their relationship with Epstein or the circumstances under which he became an investor. The success of this investment stands in contrast to his significant losses in Bear Stearns and raises questions about whether his investment performance was genuinely strong or whether he simply got lucky with a few bets while losing money on others. Looking at Epstein's overall investment record, the picture is decidedly mixed. He had some significant losses, particularly in Bear Stearns, where his loyalty to his former employer appears to have clouded his judgment. He also made at least one highly successful venture capital investment, though it's unclear whether this was the result of sophisticated analysis or simply having access to exclusive opportunities through his social network. The lack of comprehensive performance data makes it impossible to assess whether he was actually a skilled investor or whether his wealth came primarily from fees charged to clients rather than investment returns. This ambiguity is itself telling, as legitimate wealth managers typically have extensive track records that can be verified and analyzed. So, what happened to all of Epstein's wealth after his passing in 2019, just 2 days before he died? Epstein signed documents transferring all assets into a private entity called the 1953 Trust, presumably named after his birth year. This legal structure ensured that beneficiary information and asset distribution would remain private and shielded from public view. For individuals with claims against the estate, this created significant legal obstacles, as accessing financial disclosures required court approval and lengthy legal processes. The use of such a trust structure, while legal, is often employed by wealthy individuals seeking to maintain privacy and control over asset distribution after death. Financial filings from the estate indicate it was initially valued at over $500 million, though this figure has been subject to revision and dispute. A significant portion of the estate has been allocated to a compensation fund established to settle claims. The true source of Jeffrey Epstein's wealth remains as mysterious in death as it was in life, despite extensive investigation by journalists, attorneys, and financial analysts. The financial mechanisms that generated his fortune remain largely unexplained. Hidden behind legal structures, sealed records, and a network of individuals who have chosen silence, we know he had one confirmed major client, Les Wexner. We know he was connected to a massive Ponzi scheme. We know he charged extraordinary fees to billionaires for undefined services. But the complete picture of how a college dropout with no credentials built a $500 million fortune while operating in total secrecy remains one of the greatest unsolved financial mysteries of modern times. This case reveals important truths about how wealth and power intersect, how social connections can substitute for transparency, and how the ultra-wealthy often operate by different rules. If you found this financial investigation interesting, check out more content on business mysteries and unexplained wealth. Thanks for watching.